down the hammer and pick up the pencil. You're about to listen to the Savvy Radio Show. Learn from real-life real estate investors, experience revealed with the Savvy Landlord as your host.
Ladies and gentlemen, boys and girls from around the world, I'm super excited. Why? Because I get to hang out with my partner and friend and accountant. And we're trying to schedule these podcasts because we realize a lot of people, investors, young investors, even old investors, even professionals need reminding of their accounting, how important it is. And we make accounting an afterthought. And I think that's wrong. And so, which is really cool. I scheduled this time with Rose on a accounting question that a lot of my friends keep bringing to my attention, acting like I know what's going on and I don't, which is contract for deed. I just did a podcast on that. You can listen to it. The last podcast talks about this, but I actually have another question for you, Rose. I don't mean to spring this on you, so don't get mad at me. So a friend of mine, here's a question. A friend has a lot under contract and he was going to walk away from this lot. He wanted to build on this lot. And I was like, no. I go, first of all, I was like, when does your contract expire? He says Thursday, which, Rose, that's tomorrow. So I need you to answer this question today. Okay. And I was like, well, here's a solution for you, my friend. What if we split this lot and the day we closed, we put a sign in the yard and try to sell it on terms? I know this lot's probably worth $20,000. We have it under contract for $6,000. So my friend puts in $3,000. I put in $3,000. I market the property, or he does. We both do. And then next thing you know, we charge $200 a month. The question is, how should we do the contract? Or should we, one, do an LLC? Or do we buy it and make a gentleman's agreement? Like I bring the cash, he brings the cash. What's the right way to do this? And I know that there's a thing called depreciation, but this is land.
Yeah, there's no depreciation. It's just straight gain.
Now, should I create an LLC with him? If I create an LLC with him, then I have another tax issue.
Mm-hmm. And this is what you have to think about too. Like you're doing an installment, that's a long-term thing. So you're going to have a tax issue every year until it's paid off.
Now, do you record? Now that we're going to get into this with contract for deed, do I record that sale on the front end? So I buy it for $6,000, I'm selling it for $20,000 on paper. My understanding is a lot of investors don't know this, that you're supposed to record that sale and pay the tax on that sale. And in this case, it would be at my tax rate, wherever that would be. And at his case, it would be at his tax rate.
Right. But it's difficult to do that when you are not like have a separate LLC together. So I don't know the details of like the contract is probably in his LLC. So does that mean his LLC is the one that has to close on it?
Well, no, this is why he called me. He's like, do I need to make an addendum to the contract and put that contract in his name and in my name, my LLC, and we can title it that way? Mm-hmm. Or do we create our own LLC and we both own it, which is not difficult, but then it creates a tax burden?
The correct way to do it would be to have a separate LLC that you both own. And then that LLC records the installment sale and records the deferred gain. And then you have to record that gain every year, that as long as they're making payments.
And then, well, we'll get into that with contract for deed. If the guy bounces out who I sell it to, then we have to do a foreclosure on paper, which the only reason why I know all this stuff is because you taught me this stuff. But
right. I mean, I don't know. It seems, so you're looking at a gain of what?
14,000 if I sell it for
14,000.
But it's potential I could sell this lot for 35. It sounds juicy, but I don't want to cut the grass. And so as soon as I close, I'm putting a sign up, and that's my motive. It's like, hey, I see an opportunity. We may build on this site some other day. It's an asset. And this is why I coached this guy. I was like, bro, do not just walk away. He was just going to walk away from this lot. And it came up that we could just be partners on it. I could just maybe offer him. I didn't want to offer him an assignment fee. Let's do this. I wanted to teach him how to win. He was going to walk away from it. So that's really the gist on my part. Do I really want to screw around with a lot? No. I mean, if I don't sell it, I got to cut grass. I don't want to cut grass ever again in my life.
Right. So now you're going to have this other entity for $14,000. I mean, is it
Of profit that I have to pay tax
profit?
on.
Yeah, but then you also have the expense of, okay, now you have another tax return every year, and
It's
you
a
have
single
to,
tax return for that one LLC,
right.
which is $300 minimum. I don't know what a tax return costs these days, but I'm just guessing $300 to $700, right? I mean, is that a fair assessment?
Minimum, yeah, because installment sales are, I mean, even though it's just one, you still got to record it every year. And if they're paying interest, you need to issue a 1098. So that's why I'm just like, I'm asking you, like, is this what you want to do? Do you pick up every penny that you come across on the sidewalk?
Oh, so this is why we don't like each other sometimes. Because no, for real. I mean, that just makes sense. It's like, so the easiest thing we wouldn't want to put it in an LLC. So the easiest and fastest is do an addendum to the contract. This is why this guy asked me to put it in an addendum. And then I just record it on my side the way I need to record it. He needs to record it on his side and just let the accountant know this is just an added asset to that LLC.
Well, I don't know. I don't have an answer for you because I don't know how the contract's written. And a lot of times, some of these questions sometimes get into more legal questions than accounting questions.
Okay, so for the scope of this podcast and for the easy, cheesy people like myself, it's just I'm going to record it on my books as an asset that I have $3,000 invested in. I'm not going to book the amount until I sell it.
Or he records it on his books and he records the installment sale, but you have it on paper that you get some sort of.
Right. That's like a relationship, like a gentleman's agreement. Like, right. Hey, here's my $3,000 you owe me, or the company owes me whenever. So on my books.
Plus X amount every year, so on and so on. And that way it's just really recorded on his books as an installment sale. And then he's paying you like a commission or royalty.
Right. And I would pay tax as earned income from him.
The ordinary income. Yeah.
And then I can put a lien on the property for $3,000 if I wanted to be sophisticated real estate investor, which I recommend you do. Don't be casual. Casual is casualties.
Well, gentlemen's agreements are casual.
Yeah, I didn't mean to say it like that. Plus, that sounds sexist of some sort when I'm talking to a female. But I didn't know. Ladies' agreement. I really, honestly, I didn't know what to say. Like, I have to make this decision after this podcast and call this guy back because he's holding him up at the title company.
But also, like, it's $14,000. How about you just do a loan?
Loan him $3,000. Like, this person doesn't need the money.
Okay, then why can't he close on it himself?
He can. I just got involved. Problem
here? I know. That's why I'm like, why?
Because I want to. Okay, this is a good question. Super accountant. I was going to say little, but super accountant. Because I want to buy assets. I know.
What's your time worth?
It's easy. I send the money. I'm done. Now, I guess my time would be worth dealing with accountants that are going to ask me these boo-boo questions of recording it properly. but the reality is my job as a real estate investor is to buy assets. This asset, in my mind,
you're thinking of it wrong. Once you deed it out, you don't own that anymore. You own it's not an asset.
It's in my LLC.
Yeah, but you're selling it. You can't look at it as you own it.
Well said. Well, I own the paper that pays the money.
Just like the bank owns the paper.
Right. Well, here's my variables, since you operate with your left brain and I operate with my right brain of creativity, I look at it as, okay, this guy could go the distance. Wonderful. If he doesn't, I return it back. Yes, I got some paperwork, but I have an asset. I can build on this thing. I could buy the guy out. My partner could disappear and doesn't want to deal with the headache anymore. I just see there's more opportunity than, because of the paperwork scenario, because I'm uneducated as an accountant, I don't want to stop me from buying assets. Sure. Not trying to be mean.
I'm all for creativity. I just, This
is why it's good that we conflict. And this is why it's great that we're partners, because I'm going to make it work. and you're going to make it work on paper. Or you're,
so what's going to happen is you're going to make it work, and then I'm going to go back and see, well, how did he make this work? and then I'll figure it out.
Yeah, and I think that's a great point of why I would love for you to be on the radio show all the time. Is I think that people will be inspired by that, or have this intimate relationship that they have with an accountant. The great thing is that your mind is investment related, and that you're just, you strive. I saw that yesterday where you try to think, how could we make this work better? Or how can we make it more profitable? Or, put it in a different LLC.
That's a little tangent, but that's a good win for like our client. They were talking about selling the building, and we're like, why would you sell that building? Right. Okay, let's get creative here. And now we have a call scheduled next week. So,
or why pay it off when in that industry, it doesn't make sense where,
Exactly. Yeah. So let's.
All right. Well, thank you for your time. I still didn't get the answer.
You didn't get an answer.
But I think the fastest and easy thing, if you really want to know what I'm going to do, I was just like, hey, just put it in my name as well. And then I can always transfer it out of my name later, or transfer it, give him, or he can pay me my $3,000 back. I'm going to record it on my books as a loan, like you said, which is super savvy. Thank you, super accountant. I'll record it as a loan, and then draw earned income tax on that, whatever I need to do. And then whenever I make that decision, if we do sell it or whatever happens, how we record it from there, we could be nimble. We could put it in an LLC and then sell it. Or, and this person may not have a robust accounting firm that could be that nimble. And I think that's important, that people need to know when you're finding an accountant, are they nimble? Are they, responsive to these needs? Like I literally are closing tomorrow, and I was just fortunate that we had this call, because I know you're busy. It's not easy for me to, even though I'm your partner, I got to schedule flipping time with you. I'm the one that jumps all the time. Anyway, let's get into our real thrust of this conversation, because we only got about 10 minutes, maybe 15. So the biggest question that I get all the time is contract for deed. What's the pros and cons? After I spoke with an attorney for a length of time on a transaction that I had some issues with, they brought to my light some negativity of contract for deeds. And so I'll explain it on my side real fast. And then I would love for you to break it down to your side. So contract for deed, ladies and gents, is that you're selling a property that on terms, on a piece of paper, where it's still in your name. You, the owner, is still responsible, or the seller. This person, the contract for deed, the one that's buying this property, thinks that they're owning it, and they really are. They have equitable interest because they put money down. And that's the key word here, equitable interest. If you had to foreclose on, you have to foreclose on this person. Yeah. And this is where it got real scary with me, where I had someone bounce out and disappear, but no matter 30 years from now, they can come back and say, I have equitable interest because I have a contract for deed, even if it's not recorded. So one tip that I did learn, which I'm not a big fan of, is that if you're really going to do a contract for deed, you should do it right on the accounting side and do it right on the county side, where you record this for your protection. And, we can dive deeper into this on my side. And after I've spent thousands of dollars talking to this attorney, realizing I'm taking all the risk, I'm taking all the liability, because the liability is still in my name. They're only putting down $3,000, $5,000, maybe even $10,000. Their risk is extremely low compared to me. Now, I just did a podcast on this, and they're all excited that it worked out. They made money, we made money, but still. So what's the proper way to record a contract for deed? And some people don't even record that. And is there any legal consequences with the IRS in that regard? That's one question. So let's start there. How to properly record a contract for deed.
Okay. So a contract for deed is, like you said, sometimes it's called a land contract too. Basically, you're selling it on installment. You have an agreed purchase price, you have a down payment, and you have interest. Those are the three components. The way it's recorded is that asset is technically removed from your books, but instead replaced with the paper asset, the loan balance. So, and then it's offset by that deferred gain, which is also, it's a liability really, because it's a gain on your books that you have yet to record on your profit and loss statement. Where I see a lot of investors go wrong is they fail to inform their accountant that this property was on a contract for deed
for 5 years
or whatever. And so every month, that monthly payment is just being recorded as rent income.
And what's the liability with that versus as a?
Well, you're recording too much income, because really you should only be recording the interest income and a portion of that deferred gain.
Okay,
so like, let's say your payment from your buyer is $500 a month. If it's not being recorded properly, that $500 is every month is going straight to income, as opposed to $250 paying down the principal and $250 going to interest income.
Okay, so let's also bring people to light. I'm selling this property for $50,000. I bought it for $25,000. You keep saying deferred gain. What you're saying is that margin between I bought it for $25,000, my basis points, and I sold it for $50,000. I have to pay tax on that 25% gain, $25,000 gain, correct?
Right. So that's why if you sold it straight, if you just did an outright sale, you would be paying that tax in this year, as opposed to an installment sale. You could spread that out over however long your contract is, 10 years or 15.
Okay, so you're not paying all the tax on the front end.
No. Now, what you are paying on the front end is that recapture of the depreciation. So if it was previously a rental,
okay,
and then you want to contract it out, then you're going to pay tax on that depreciation that you've already taken.
So for 10 years, I've been taking $2,000 a year. That's a $20,000 depreciation.
And
I have to pay back.
And that's exactly, and that you're going to recapture in the first year. So really, I always tell people, like, if you're thinking about doing a certain property on contract for deed, talk to your accountant, because it may not be the right move.
Yeah. Contract
for deed is not for everyone.
I figured that out.
Some people they get so caught up of like, I'm a real estate investor and I got to do this 1031. I'm paying too much tax, blah, blah, blah. It's not for everyone. If you are a patient seller, if you are not strapped for cash, it might be a good way to finalize a deal, but it's not like it. You don't shoot yourself in the foot to save X amount in tax.
Well, I think it boils down to, you always ask me, which drives me crazy. I want to scream, what's your goal? What are you trying to do? I'm like, I don't want to tell you what I'm trying to do. I'm trying to be secretive here. And you're like, I'm going to find out anyway. But the reality for me on the contract for deeds is the headache. I don't want to do maintenance. And my business was spending $400,000 a year in maintenance. And then as soon as I put majority of these on contract for deed, it took 3 to 4 years. My maintenance went down to nil. I mean, we're talking.
It should be nil if you don't,
Well, right. I mean, I still own some, but then I realized this tax burden, this depreciation, basically, it's not. So I guess I wouldn't call it tax burden anymore. The recapture of depreciation, and I think that's a lot of investors don't know that. They just got this headache, or they think the margin seems so good. I'm selling it for 50. I made 25,000. You're not really making 25,000 because you've made money off the depreciation. Right.
And the other thing is, people get worried about their capital gains. Capital gains they're not that bad, 0 to 20%, but depending on what your other income is, if your income is, let's say, $100,000 for the year, you might be paying 0 capital gains.
Right. And then let's go into that real fast. I mean, how do you pass on equity over? I noticed at one time I was like, Rose, hey, I want to do this transaction personally. And you're like, oh, you have enough equity in your business that you can pull out that money tax-free, right?
Well, now we're going down a rabbit hole.
Okay. All right. We'll make that. We got 5 more minutes here. Okay.
As you've been in, the longer you're in business.
Okay.
You have so many years where you're building up net profit, and that's your equity. in your business. So a new business is only going to have what you've invested.
Okay.
But if you're profitable, let's say every year you're making your net profit is 50,000, right?
Okay. Right.
You're paying tax on that 50,000. It's going to go on to your tax return. Now we're talking about S corps here too. This is important to know. But that 50,000 also goes into your equity year after year after year after year. So you have all this equity built up. And then when I say, oh, you have enough equity, that means you could take that out and it'd be tax-free. That's one of the beautiful things about S corps.
And that's what people say with real estate is like you refinance. Say it's like I refinanced my apartment the other day, let's say, and I pulled out $300,000 of that refinance, and it's tax-free in essence because I had that much equity built up. I could take that $300,000 and pay off my residence, let's say.
Well, no.
No, well, it was equity built up.
Yeah, it is equity built up. But technically, refinances you probably want to put into other investments.
Yeah, yeah, of course. I'm just giving. All right, that wasn't the best example. You should always be. This, you guys. You see the chemistry that this gal and I have. I mean, it's like dogs and cats here fighting. But the great thing about you, Rose, is that you're willing to not accept everything as solid, right? I mean, everything is interpretation. I hear that a lot from you. It's how it's interpreted. All right. What other tips could you give for people? So there's so many nuances. You said the three things in a contract for deed. It's what's the depreciation,
the sale amount,
the amount,
how much interest you're charging, and how long this contract is.
Okay.
And, this is, I know we're keeping it really high level, but there's a lot of rules and regulations on installment sales that you have to be followed carefully. There's been issues where people I know have gotten into predatory lending issues.
Dodd-Frank?
So what?
Dodd-Frank law?
Yeah. So, I mean, you have to look at it, just be careful. And there, the main tax consequences are how long you've owned the asset, your marital status, income tax bracket, and the cost of owning that asset. Okay. So that's why I say, talk it over with your accountant.
All right. One last thing. So what if I sell this thing 5 years later? I paid recaptured my depreciation. I had to pay that back over that 5-year period, or no, it's due that first year. And the couple leaves. Now I have this asset back. They actually deeded back to me. If I did it all legally as my attorney is instructed, I filed it, refiled the release, basically a foreclosure, a real foreclosure. Okay. Yeah. $1,200 later, or $2,500, depends on what year you're in. Then what happens? How do I deal with that? I paid my depreciation.
Well, then there's actual tax forms that we fill out on your tax return to get rid of it as an installment, get it back on your books, but then it becomes as an asset, but then it becomes a different book value too.
Is it?
So it could be more or less. If it's more, that's good because then you start depreciation all over again.
This is where my mind gets a little sketchy. This is where I'm like, wait, maybe I should do this more often and reboot my basis points.
But then you have to look at, what's the intent? What's the intent here?
I know that's like when you convert your home into a rental. What's your intent, right? I mean, that's interpretation of the law. A
lot of times that determines the tax classification too. And you go down an audit with that, they could say, well, a lot of people start doing contract for deeds because, they don't plan for them to pay off that house, or they don't plan for them to live there forever.
Yeah. So basically what you're saying is it's possible. It's not creative, but you have to do a foreclosure on paper on the accounting side. And then now I just learned that you have to do it through the county side as well with an attorney. Yeah. I mean, after you figure it out a few times, And
the other thing that I've always seen missed is not, like I said earlier, not issuing those 1098 interest statements to the buyers at the end of the year. Like, how on your mortgage from your banks, you get the 1098 showing the interest that you've paid.
Damn, wait, hold on. 1098, what? I'm supposed to give them a.
Well, we do that for you, but.
Are you?
But I see
just
that
like I do this with
too.
my private money. I do this with my private money. Like, is this called? It's a 1090. Okay, what is it called? 1080.
1098. It's just mortgage interest.
Yeah, I tell them this is how much money you paid me. I paid you an interest. So it's the same thing. It's reversed. Okay, so I'm supposed to tell them what they paid. Okay.
Yes, you're supposed to, but also your banks give them to you at the end of every year too.
Yeah, I look at that, but that's how much money they made.
Basically, yeah, but you have to report it.
So am I required to do that for a CFD? Is that like illegal? Well, is there like a contract for deed police?
I'm sure. I'm not it. I just, I want my clients to be recording things the right way, and that's why we always ask for. Do you have this agreement?
Is that why it's tough for us to get real estate clients to be on the firm? Because you want to do it right. Well, I'm just playing.
Yeah,
I've noticed some investors though. I noticed some investors, I don't do it that way. I've heard that before, and
here's another thing to look at too. Is when you're putting together your financial statement, all of your assets that you truly own, you're able to include the market value.
Yeah,
okay.
I do that.
When you do a contract for deed, you don't have market value anymore. You have paper value.
What you sold it for, which better be more than you.
And that decreases every year as they're paying down that principal.
Yeah. Interesting. Well, how do they get a hold of you? p3accounting.com. If you have any questions, this is, guys, I feel like
you're bummed out.
I am. I'm bummed out. It's not sexy. It's like, I don't want any more maintenance and I want to get paid. And I didn't even ask you this because I know you're limited on your time today, but what if you have a loan on it at the same time?
Oh yeah. That's a whole other can of worms. And I just let the bank deal with that.
Well, I just did that podcast and I sold it I bought it with no money down, 25, 31 in it. I sold it on contract for deed for 45. And then those people paid for 2 years on it. And then they were like, well, we want my payoff. And then they sold it to somebody else at 58.
Yeah.
So good luck, accountant, because that transaction just happened.
Okay.
So, but it was weird how they titled it all in. It was.
But they did it. But they did that all themselves.
Right. I mean, right. So on paper, I've already classified this as a sale at 45. Basically, now I have to pay all that gain now of whatever the $24,000 check I received because I had a note on it for $12,000.
Right.
But that bank got paid off. But it gets complicated. But is it possible? Sure. It's called a wraparound mortgage.
Yeah.
And do you do that? That's another question on another day. All right. Well, is there any last sentiments? And I'm bummed because I have, I didn't ask you this stuff before. Actually, a lot of investors do this. This is why they call me. They don't tell their accountant that these are contract for deeds because it's not titled in their name. Well,
and sometimes like accountants, we have to be Sherlock Holmes.
Well, I think you're just helping for the right reasons. I mean, to be recorded. I mean, that's how
we don't. And once we get the contract, we make an AM schedule too, so we know how to record that payment every single month.
And when I sell them, I give them an AM schedule. But
right, okay, well that's good. Some people don't.
Well, I don't want them calling me up. What do I owe you? It says it right there, page 6, line 10.
Well, and then there's another layer of complication too, like when you're doing escrow. So
it gets real nutty. We're taking this too long, but like I've had people show up with an extra $5,000. I get so pissed off because it throws off the whole AM schedule.
And technically they should say, okay, is this
principal? Well, we put it towards principal because
it should be towards principal, but
right, because they're making their consistent payment. But actually that's happened to me on my own residence where I was I thought I was paying principal, but they were recording it as a payment. And they're like, yeah, you don't have to pay for 20, 50, 55. I'm like, what the heck? Oh, no, what, but that was in my Dave Ramsey days.
Just final notes. There are some things that just cannot be done on installment sale too. And that's per like IRS regulations.
Like, what do you mean?
Like inventory. So that was one thing I think that you and I talked about several years ago when you were selling a business. I was like, hold up, be careful how you write that contract, because if you want to identify of the sale price, what's inventory and what's not.
Because you can't depreciate. Say that again. What can I do on that?
You can't do an inventory on installment sale.
Oh, that's right. I remember because I classified X amount for the inventory and I had to pay tax on that.
Yeah. Yeah.
Because I bought that previously and expensed that out, let's say, through the company. Yeah, I remember that. This is where I learned the word goodwill. Yeah,
that's right. Goodwill. I don't think you can do installment sale on timeshares, personal property, and of course, stock and securities.
Interesting. So, didn't even know that.
There's a lot, like I said earlier, there's a lot of intricacies of installment sale.
So, fun fact here, Rose, what makes you want to know this information? Do you find satisfaction in being the know-it-all? No, I mean, but just like, why do you like that? Why do you, I didn't even know that. Why is this just something that's ingrained in you? You want to know this information? Do you apply it to yourself? Tell us more about Rose.
Well, first of all, the last time that we had a call, I feel like you brought up know-it-all, and I'm like, I am not a know-it-all.
When I'm the know-it-all, you shoot me down. So then you're the know-it-all.
I am passionate about what I do, and I have a federal obligation to inform people the right way. And look, people hire me because they are relying on my professional opinion, my professional experience, and my professional expertise. So,
man, you take it so serious. That's awesome.
I'll smile and laugh along the way.
Yeah, I mean, I'm glad I found you. I'm glad that we're friends, and thanks for educating investors. They can get a hold of you at p3accounting.com. If you have questions, you can get a hold of me, savvyinvestors.com, or my Facebook page. If you have any questions, because that's
What should we talk about next?
Should we do this off air? I mean, I don't know what.
I'm in for another podcast topic.
I know we're supposed to do these on a regular. I don't know. I'm going to have to email you. I'm already just irritated.
The one that we were talking about was like my brain versus your brain.
Creative versus.
What was the word that I forget? We were just talking about it yesterday, but the way I do business and get paid and how other people.
Yeah. Like, I wrote that down. I can't remember, but basically what you were saying was, like, I have a strategy to run the business, fast, furious, grow, don't spend money, only to build. And then there's another strategy, which makes sense. And someone asked me this question yesterday on a new venture that I'm doing. When do you expect to get paid? Or, and I think those are good. Like, I think you need to have these defined when you're going into a business model. And I learned that through you, which as an entrepreneur, I'm always growing and trying, and I want to make money, but at a different pace, which sometimes there's businesses that you just acquire those assets. They start paying, like I bought the liquor store and it started paying day one. I mean, I bought that for that specific reason, not to get more rent. I bought that asset so I can be making $1,500 a month. I could clean it up, wait 6 months, record it differently, and then put $50,000 in it and start making $2,200 a month. No, I bought that asset. And I think that's where we business owners and partnerships, I think they really need to dial in on, what do you want to happen? And as soon as possible, do you want your money back first? Or do you want us to distributions? Or do you want to put money? Because I remember the conversation that we had was like, we had some money in the bank. I'm like, hey, let's go leverage this money and go buy a piece of a property. And even if we paid retail, I was even like, let's pay retail. Yeah. But we can make my mind is like, let's let's leverage that money to make more money. And your mind was like, this is going to be an accounting nightmare. Now we have this asset that we own together in this business, and the money goes directly towards the business. And it made sense. But in my mind, I was like, we're growing. Does that remember that conversation when we had that money? Yeah.
Well,
we'll make that the podcast. What is that? The mind?
Well, yeah, that's just, I think, business ownership podcast.
We can do a whole series on, I don't know. I have so many accounting questions. I heard one yesterday. I overheard you're communicating, advocating someone on an allowance for their vehicle. I think that was very interesting.
I think the word was accountable plan.
Yeah. We'll let it simmer for a minute. I'll give you a list of questions that people keep asking me, and you do the same. How my entrepreneur mind is different than your entrepreneur mind. And, it always boils down to what you always say. I just want to roll my eyes. What's your goal? And I'm like, my goal is always to make money,
Right. But we want to minimize the tax consequences as much as we can too. And a lot of times that starts at the forefront.
Well, I mean, it's perfect sense what you just said. It's like, I want to make money. Good job, VanCauwenbergh. But can you maximize the money you make? Are you throwing it away in taxes?
Yeah.
And that's where you come in. It's like, okay, slow down. What are you trying to do? Do you really need this asset for $14,000? Is this going to be a giant headache? And now your accounting firm is going to charge you a new tax return. You're right. It sounds sexy to own another LLC, but it's really a headache.
But what's the point of having all these dozens of LLCs if they're not
generating income?
They're not generating income. Yeah.
Yeah. Well said. Well, cool. Welcome to the Savvy Radio Show, part 2. I don't know. All right. See ya.
Bye.
Thanks for listening to the Savvy Radio Show. Glide online and listen to our other motivating episodes at savvyradioshow.com. Connect on Twitter @LandlordBook and always be buying assets.